you know what it's gonna put a bottom in, and there's gonna be a new bull market. Bitcoin and gold will outperform, absolutely. As soon as you get a pivot, gold is gonna rip because the dollar will fall, and Bitcoin still has some downside because it's still a risk asset, but down the line in like a year, I do expect a major bottom in Bitcoin.
Hold up.
There's no doubt that there's panic in the markets, but per the VIX, we haven't hit the levels where I would say there's a market bottom yet, right? So I've been consistently saying, yes, you're gonna get bounces when you get these big sell-offs, 2%, 3%, you get that kind of mid-level panic that triggers a bounce, but by no means is the market at a near bottom yet.
Why do you say that? Why aren't we near a bottom?
Well, because number one, you still have a Fed that's aggressively hiking. As of now, we'll see what the CPI data is coming up, but for the most part, the Fed is hiking. We have an economy that's going to slow down, and I think to be honest, that's one of the biggest concerns I have. And this is kind of shocking. This will be shocking to people, but you have $1 trillion in savings that consumers accumulated over COVID, right? And so the Fed is saying, oh, look at these jobs numbers. They're still very, very strong. People are still spending. The consumer's still doing well. So we have to continue to hike rates. Problem is, consumers are going to run out of that money that they saved probably by mid next year. And my biggest fear, and this is this could be what triggers a massive kind of recession, if not worse, is that when they run out of money and the Fed has just hiked and hiked into it, there's going to be a cliff dive in the economy. A recession can be mild, right? I mean, you could have, okay, it's a little minor recession. I mean, even the Fed has said, hey, we don't care if we push the economy into a recession. But a cliff dive, that's where you have unemployment going to 5, 7, 8, 9, 10%. And that's where you get in trouble, where the Fed then has to start lowering rates instead of just going to neutral where they're not hiking anymore. And potentially down the line, I do worry that it's going to get so bad that even with 4% inflation, you still could see a point where in like a year, 2 years from now, the Fed has to actually start QE again. Well, all right, so technically per GDP, you can make a case for that, right? But I think a lot of people have argued that it's not a true recession because you have to deal with the COVID aftermath and then what's going on with that kind of stuff. So you had COVID kind of affecting GDP for a while, and the jobs numbers have been strong. But again, I would strongly encourage people to understand is that, yeah, when people save a ton of money from not driving to work, from not taking trips, there's going to be a lag effect for economic hurt. But once people run out of money, I mean, this is what, again, keeps me up at night, is that the Fed, for some reason, doesn't seem to be allowing for that or understanding that. So they're like, oh, the jobs numbers are strong, so we're going to continue to hike, this and this. But I'm telling them, like, at some point, you are going to see the consumer run out of money, and that is going to kill the economy fast. Probably not. I mean, I think, right, so Putin's been kind of threatening a little bit, and you hear a lot more talk in the public eye from politicians about the chances of it, so it makes sense people will search for it more. And then also, right, we have to think about risk models, right? So if you're a hedge fund, if you're an institution, yeah, it might only be a 0.001%, but the question is, how does your risk model adapt to that, and does it mean that you have to take a lower positioning in certain stocks? And so I think it makes a lot of sense that it is correlated. Sectors I'm bullish on remain gold. Gold miners.
Oh, sorry. Let's focus on just the stock market.
Just the stock market. All right.
S&P 500.
So for me, I think Brazilian stocks, the EWZ is an ETF that tracks. Okay. It looks like it's breaking out here. I've been a big talker over the last 6 to 12 months about how people and institutions have overinvested in the US because it was the safest spot during COVID, so all this money came in, and they're underinvested in foreign markets, right? So you could even talk about China, although China has taken a big hit lately, but I think the EWZ is a beautiful chart, and I think people want to start looking other places. If we're going to be in a long term, and I told you this last time, I truly believe we won't see a new all-time high in the stock market for 10 years.
That's right.
Yeah, I think it's going to be these trusty stocks like an Apple. And again, percentage-wise, maybe not, but I think people will be shocked by how much more downside Apple can have. I have a price target under 100 on Apple for probably the next 12 months or so. And again, it's trading, last I checked, I think 140s or so. So you're talking about another 30% downside move in Apple. That's be affected. But I do think there are certain growth names that are smaller that have already been trounced 80, 90%. And those could see a little bit of a less downside. And again, keep in mind, everyone has run towards Apple, Tesla, these trusty stocks, including institutions. They've overinvested because it was supposedly the no-lose situation. And I do worry that there's going to be an exodus in those names, which, by the way, you have Apple dropping that much. Think about what the Qs could do, the NASDAQ 100. I mean, you could see some major downside in those names. So I just want people to understand is that you go back to pre-printing periods, which is a long time ago now, you had companies like Apple in the past, like the Apple of its time, trading at an 8 or 10 PE ratio. Where's Apple? Apple's still in the 20s in terms of PE ratio. So I mean, if it ever comes back to this mean or medium point, you're talking about a lot of downside potential. Again, as we get into a period where growth is harder to come by for tech stocks, I think you have to look towards these staples that people need. Like one of my favorites is GSK. Right now, GlaxoSmithKline, it's been crushed. But it pays a great dividend. And what are people going to stop taking their blood pressure medication in a recession? No, you still have to take it. So I think you look for pharmaceuticals, I saw Amgen on that list, those type of names still have that. And again, it's not to say they won't go down, but it's about what will perform the best.
Anything, and you would have made money.
Anything. And again, I mean, that's what the market is going to have to grapple with, is that, we're going to get in a recession and every investor is going to say, okay, we're in a recession. Hey, Jerome Powell, can you please print us some money so that we can see this recovery in a month or a year or whatever? And the Fed, in the beginning, the Fed is going to be very reluctant to even lower interest rates. I think you're going to see them go to 50 basis points, then 25, then neutral, but they're not going to want to lower until they see inflation get to 2%. On the other side of the coin, at some point the recession gets so bad, I think they will have to do it anyways.
Okay, beautiful.
And I think they won't want to do, if they've done 75 3 times in a row, it's unlikely they would now jump, because that would really freak the market out to go to 100. So I think you're going to look at 70, or if the CPI data and the economic data shows that we are seeing a lowering inflation number, then maybe you get a 50 in there. I do think that a lot of other central banks, like Bank of England, we know they've stepped in here. There's a lot of concern out there from other central banks saying, hey, Fed, you're doing this too quickly. Our economies, our currencies can't handle. You're going to break us. I mean, we kind of did see that in the UK.
Right.
Don't have to be. I hope they listen to that. I do worry, like I said, is that they're aggressively hiking, and it takes. We've seen the stats. You've seen the stats. It takes a certain amount of months for every rate hike to filter into the economy. So the question is, if you've done 3 already, and let's say they do another one in the beginning of November, when do we actually see that impact? So it's almost like you're raising by 3% on the Fed funds rate, and we may not have even seen that hit the economy yet. Obviously you've seen it hit housing, right? 7% mortgage rates. Think about housing, how fast that's coming down. I'm seeing it in Florida everywhere, how people are pulling out of deals. Absolutely, because number one, we've heard about Credit Suisse, right? There was rumors just a couple weeks ago or a week ago about Credit Suisse having issues. And the thing is that, the Fed has enabled the financial sector to do a lot of the same things they did in the last financial crisis, right? It's almost like no one's learning from the rules. Even Dodd-Frank kind of got pushed under the rug a little bit. And that just, so it's like the short term, everyone's just focused on how can we be the most robust economy in the short term. Well, guess what? Eventually that breaks, and that is an issue for sure. Fed isn't gonna, so there's two things. Everyone thinks a pivot is where they start dropping rates. Yeah. My pivot is where they go from 75 to 50. So it's like the downsloping mountain versus the upsloping climb.
I'm talking about just straight up stop raising rates.
So just going to neutral. I do think by 2023, early first quarter, they're done. And I think you're going to see the jobs numbers. At some point, these jobs numbers are going to crack, and we're going to see a big drop and a fast drop. And again, this is going to coincide with people running out of this COVID savings and all of a sudden really pulling back. And think about 401ks. Think about your house. Like, as we see the housing prices fall, and we're starting to see that now, the wealth effect disappears. And people feel like it's one thing to say, I'm going to go buy a new car because my house just went up 100K in the last 3 months, and you know what, the economy's rocking. But now all of a sudden your house drops 100, 200,000, and you have other factors that are pulling you back. Now you just put on the brakes and the cliff dive occurs. But if things get bad enough, but I would be surprised. I would be surprised if it gets that bad that quickly. Yes, I'm talking cliff dive, but I think with inflation, and I don't expect inflation to go back to 2% anytime soon. We're talking years above 2%. So they're going to be very reluctant, and this is going to be another point where we're going to all say the Fed was late again, just like they said it was transitory, it wasn't transitory, just like they said so they're always late, and then they always overdo it. We're seeing it right now. They were late about inflation because they thought it was transitory. Now they're hiking ridiculously. It's the same thing is going to come in. They're going to wait too long to lower rates and start stimulating, and then we're going to get into a much worse situation, and they'll have to drop rates and print even more money. Look at the balance sheet, by the way. Fed's balance sheet, it goes like this. It goes up sharply, and then they try to bring it back down. It goes down a little, and then up sharply again and down. You know, that's the way the Fed works, unfortunately, because they're human, number one, and number two, sometimes, honestly, I don't know what the hell they're thinking. Sorry to say it, but...
Why next year?
So my guess is it will signal a major bounce. But again, like I said before, stock market to me, 5-10 years before we make a new all-time high. But you know what it's gonna put a bottom in, and there's gonna be a new bull market. Bitcoin and gold will outperform, absolutely. As soon as you get a pivot, gold is gonna rip because the dollar will fall. Yeah. And Bitcoin still has some downside because it's still a risk asset, but down the line in like a year, be clear on this, not making new all-time highs.
No new all-time
So like
highs.
think about the .com, right? It took 15 years to make new all-time highs on the NASDAQ. Yeah. If you look at the Brazilian market, if you look at the Hang Seng, both those markets made their highs in 2003, and they have never taken out those highs, but you've still had mini bull markets in there with huge moves to the upside. Yeah, you would think that it wouldn't make new all-time highs, but I actually think that there will be a pivot in Bitcoin as it matures, as regulation helps people feel more confident, institutions feel more confident. You're going to start to see it being treated much more like gold, which will then
it's going to start diverging from the stocks.
It will. Not yet. I want to be clear to everyone out there. It's still going to take some time, but there will be probably in about 12 months a divergence. So first support is 12 to 13,000. I think in the near term, we're going to see a little bit of a bounce, then a wave down to 12 to 13, and then I do worry that you're going sub 10 to 8, maybe even worst case scenario 3,500. 3,500, very small percentage, but that would be the equivalent of Amazon.com's collapse in the .com era if it were to equal that.
Okay. Gold?
Gold, I'm still a huge bull on gold. Remember, dollar's up 20% this year. Gold at the lowest was down 7%. If it's the correlation with gold and the dollar should have meant gold was down 20% when the dollar was up 20%. So the fact that it's only down 7 or now only down 5 or so, it tells me that big money's buying gold. That means it's going up. I'm a buyer of gold.